Welcome back, Dividend family. So today we're actually going to be doing something a little different. We're going to be looking at some other M1 Finance portfolios from a couple different members from my Facebook group, which if you are not a part of yet, I'll have a link down below for you to be able to join. It's entirely for free, and we just talk all things M1 Finance and investing all together. Now, what I want to do is kind of just take a brief look at all these different portfolios, kind of get an idea of, where this person is wanting to head, and kind of give them a heads up of how the portfolio is looking across the board. Now, if you're not too familiar with M1 Finance, this allows me to actually see their portfolio and some of their percentages, but not their actual dollar amount. So all of that information is, of course, going to be unseen for myself and for you guys as well. If you are somebody who's going to be interested in this, make sure you join in on the Facebook group so you can hopefully get into the future episodes if we continue to do more of these videos, if you guys like them. Now, before we get into the first portfolio, this episode is brought to you by Earnest, which is the student loan refinance company. If you need to lower your interest rates, you can do it entirely for free with Earnest in the link down below. The coolest part is they give you a nice bonus for using my link, and it helps support out the channel so I can continue to do free stuff like this, and then you can use that extra money to invest in the market or pay off debt or anything else you want to do. All right, so now what we're gonna do is actually go and look at the very first portfolio here. And before I show the portfolio, I do wanna read kind of the little message that they sent me when I asked for this information. So they wrote, I am new to M1 and wanted to start a tester account. I don't have a ton of experience investing. I was a large cap trader for a while. I'm 30 and I would like to retire in about 15 to 20 years. So a question that they also asked as well is, can I make investing a full-time career, and how so? So what we're gonna actually do is load up their portfolio here so we can actually see everything in real time. So of course there were things blurred out because we want to keep their information private. So this is their portfolio. So this is what they sent me. Again, this is with M1 Finance. If you are interested in using this platform, I'll have a link to them down below as well. So M1 Finance does this really cool thing where it shows you the performance of these different stocks and ETFs and bonds and everything they have, and their performance with the return on the initial $100 for whatever time frame that you have up here. So right now in the 1 year, this portfolio has done 115.34%. Pretty solid. Like just right off the bat. If we go to the 3-year marker, 112, obviously not a big difference in the 2-year time frame there. And then if we go to 5 years, we're looking at 320%. And then we can kind of go backwards here now. So in the last quarter, up 20%. Last month, up 6.11 or 6.88%, excuse me. And then in just the last week, it was 3.81%. So let's just kind of go back here to the 1-year marker. And what we're going to do is take a look here and see. So we have 16 holdings. It does look like we have some ETFs in here, so we're going to keep that in mind. The dividend yield is 1.552%. Now they did mention they want to retire in about 15 to 20 years. So that means that we're not too worried about the dividend yield personally, just because of the fact that we are trying to build up the actual value that's in the portfolio. And then we can see here the expense ratio is 0.01%, and that's averaged across the overall portfolio. Some stocks, or ETFs I should say, sorry, actually have higher expense ratios, but it might lower based off the average across the board. So what we want to do is take a look here. So we have the VTI, which is the Vanguard Total Stock Market Index Fund, about 15% of their portfolio. Now this is what they target, but I don't know if this is exactly what they have on their actual pie. Their actual percentage might be a little bit higher or lower than that. Then we have VOO, which is the Vanguard S&P 500, and this one is at 15% of the portfolio. Now, one thing I can quickly mention first and foremost is the fact that these two ETFs right here are going to be very similar as far as what's inside them. Obviously, the Vanguard one has over like the 3,000 something, and then the Vanguard one is just the top 500 companies in market cap. So you're going to have a lot of overlay between these two different ETFs. Now, that's not necessarily a bad thing, but just something to keep in mind, because as great as the Vanguard Total Stock Market Index Fund is, it doesn't have typically as much growth as the Vanguard S&P 500 fund does. And so having these as a large portion just means that you are investing a lot into the similar stocks that are already essentially into this fund here, which was a really ugly circle. So just keep that in mind as we, go through that and make decisions on how do we want to keep looking at this portfolio. Do we want to keep both? Do we want to just invest heavily into one or the other? Of course, those are up to you. Now, we do also have Tesla in here. I do love Tesla. It does look like it is 10% of the portfolio. 10% is a pretty large sum as far as the overall portfolio. But if you are looking for a lot of growth and you believe in the company long term, because you still got 15 to 20 years, this is not a bad bet. Personally, for me, I do have Tesla in my portfolio, and I do really like them as well. And next up, we got FedEx, also a large portion. Obviously, I don't know if you like maybe work at FedEx or you really believe in the company and like their vision and where they're going. I know I've looked into FedEx personally myself too, and I haven't really dived deeper into them just because for me, I just didn't see them as big of a value into my portfolio. But of course, if you see them as valuable, keep them in there as well too. But just keeping in mind that 10% is a large portion for one company. But what I like about your portfolio is that 10% seems to be the max right over here for one individual company. And that's huge. That is a very big thing to note because anything above 10%, you're really starting to invest heavily into one company versus any others. And we don't typically want to do that just because that can be a large portion of the overall pie and can be very damaging if the market goes down or that individual company goes down by itself and you have so much money invested into one. Now, let me clear that up there. So next up, we have Lockheed Martin. This is at 9%. This is looking pretty solid. Same thing with Apple here, both at 9% and even Amazon as well. So those are three really solid companies, very high in growth. So I think you're going to be looking really good there. And it seems like you got Boeing over here. So Boeing has obviously still been taking a pretty big hit across the board. But if you believe in them long term, that can be some really good ROI. Or if you've had them for a long time and maybe are in the negative with them, maybe that's why you're keeping them as well. But pretty solid company. And then obviously NVIDIA has been pretty popular over the last little while. And then we got IBM. So if I'm looking at all these individual companies over here, obviously the biggest thing is that, we got some tech over here. I consider Tesla into tech, to be honest. We also got Amazon here, which is consumer, but also a lot into tech. We got NVIDIA into tech. We got Boeing and Lockheed Martin are in somewhat similar industries right there all together. And then we have FedEx, which is kind of by itself. And then IBM, which is also, of course, into the tech stuff as well, too. So when it comes to individual companies, it does seem like you are somewhat limited in the amount of different sectors that you're in, which is not necessarily the worst thing in the world, but just something to keep in mind. When you're not very diverse in sectors, you might have more ebbs and flows when it comes to the markets moving during normal times. Obviously, with world events going on right now, that might not seem like a very relevant thing because everything might be going up and down at the same time. But sometimes like health stuff goes down while everything else is going up or, whatnot. So just kind of things to keep in mind. Now, next up here, you also have long-term pie. So that's 3% of your portfolio. So in this pie right here, obviously I can see that you are looking at things that are a little bit more down the road. Obviously for the 15, 20 years, you still got plenty of time. There is a little bit of a high expense ratio in here. I'm going to go ahead and guess it's probably the gold that's causing a lot of that. So let's go ahead and take a look and see what we have here. So we have the real estate trust, which I love real estate and having a little bit of a REIT if you don't already have one, but obviously you do. So this is really good. This is 40% of this slice here. So pretty solid across the board, really good dividend yield, 4%. PE ratio is looking good too. So this one is looking pretty solid there. Then we got long-term bonds, about 30% of this. I'm personally not the biggest fan of bonds, especially if you have since I have a long time to invest in the market and everything, I just wait on going into bonds until I get much, much closer to the point of needing to retire or wanting to retire and being able to pull that money out. But until then, personally, I just don't have as much because of that. Just like if we go back here, if you look at the 5 years, this has only been 43% growth. The last 3 years is 27. The last year is 11. So you can see this in comparison to the rest of the portfolio. And sure, it keeps you a little bit more leveled, but if you are wanting to kind of keep growing the portfolio, it's not going to do it with this, this fund in particular. Now, keep in mind too, I don't know if this is a retirement account or taxable account, so just kind of something to bear in mind there. So then we got the gold at 25%. Yep, so this one had the 0.40 on the expense ratio. So let's see here, how did they do in the last year? Is that not giving me the percentage? Oh, right here. So 28% in the last year, 38% in the last 2, and then the last 5 years, about 50%, so about 10%. But if you look at that, I mean, a lot of that is honestly within the last like 2 years. Yeah, it's 38% of that is in the last 2 years out of the 5. So, I mean, gold tend to goes up when things are going down for some reason. I'm personally not into gold myself, but obviously it's still a good option there for you. Now, of course, the other question was if they can make investing a full-time career and how so. I mean, you possibly can. There's a couple different ways. If you want to take the long route like I'm doing, I'm investing into good growth, good dividends, and so that way over time I'll actually make just enough money to live off of if I really wanted to. That's the route I'm going, but it takes a very long time, so I'm a very patient person in that regard. But there are other ways that people have done it where they do like day trading or trade options. I'm personally not into that kind of stuff, but you can watch videos on YouTube to kind of learn how to do that thing. But I would be very cautious with it. If you are going to learn with small dollar amounts. I've seen some really bad horror stories with people losing a lot of money going into that route before they really learn all about investing, because there's so much to learn. Like, there's so much to keep on learning when it comes with just regular investing, let alone day trading or with option trading as well too. So going back here to the main page, across the board, I would say this is a pretty solid portfolio across the board, especially if you are trying to grow it for, of course, in the next 15 to 20 years. Obviously, the bonds and the gold kind of slow sometimes the portfolio down a little bit depending on how the market is doing overall. But everything else across the board looks like you are setting yourself up for some really good success. All right, so this next one again is from also my group. Now this one says, hey man, I'm excited to see the interest from your side. Here's my pie. He says, I've put some descriptions in every pie. There are only 4. They are kind of self-explanatory to help you see. It says the squirrel pie is the pie that I've made just for fun, but at the same time with possible growth opportunities. My question would be, is it a good portfolio overall? Would you invest in it? What is something that should or shouldn't be in it? And then how could I make this portfolio better? And then of course it says choose any of these or make up your own. Either way is good for me, and feel free to make any kind of comments. I welcome negative and positive without hard feelings, which is awesome. Honestly, that helps because that makes it feel better when I'm giving you my honest opinion on how I would see this as a potential for my own portfolio, because that's how I go with these. Always keep that in mind as well. So let's go ahead and take a look at this portfolio. All right, so with this portfolio over here, we can see with the 1 year marker, currently with this performance in this portfolio is up 13.65% if they were invested in this 1 year ago with a base of $100. So again, this is not what they actually have in their portfolio. This is just showing some examples. In the 3 year marker, we're looking at 17.38%. And then the 5 years, we are also 17.38% as well. So right over here, we're going to see that we have holdings of about 47 different companies or ETFs. We have a dividend yield of 2.386%. So if they're going for dividend yields, that's a pretty solid amount. Then we have a pretty low expense ratio at 0.03%, which is good. Usually that is going to be a sign that we have maybe like a Vanguard ETF or something. So the first one here, they have all of their different sectors or areas split into different slices. So the very first one is 34% of their portfolio. This is the safe investment pie. So here we can see they have 4 different stocks or ETFs. And then down here, we're going to see that we have the VTI, we have the Vanguard Utilities Fund, the VGT, which is the Information Technology Index Fund, and then the Vanguard Health Index Fund as well, which is VHT. Now, right off the bat, what I can mention as well too, kind of similar to the other portfolio we just looked at, is some of these are going to be kind of intertwined all together with this stock right over here. Actually, all of them are going to be intertwined with this stock here. So all of these, you're kind of essentially doubling in to all of the different companies that are in these funds are also going to be in the Vanguard VTI as well. So something to keep in mind, because this is the total stock market, so that has all the funds. And these ones are just split up into individual different sectors like the utilities, information, or health, which are not bad funds to go with, but just something to keep in mind that if you're investing into all of this, you're kind of spreading your dollar pretty thin there. just as a thought process when it comes to that. I personally like just having one ETF because then I am just really engulfed into that one as long as it has what I need into the overall stock market, which is for me a lot of the growth companies that are out there. That's what I like to focus in on the most. All right, so now going on to the next area over here, we're going to go into this slice that's called ETF, growth, and dividend investment strategy. So this is 33% of their portfolio. Two holdings, which we have the Vanguard S&P 500, which is the VOO, and then the Vanguard Dividend Appreciation Index Fund. Now, again, very similar to what we just talked about earlier, this is going to be a lot of layover from one ETF to the next. Not necessarily just these two, but these two from the total stock market index fund as well. So these obviously have a little bit more risk to them, you can say, especially with the S&P 500. But you can see that the performance on just this sector here is going to be much better than the overall, which if we go back, so that was 73. So you can see here, this is 17, and then the 5 years from just that one slice right here is way, way more across the board. So next up here, we have the dividend individual stocks strategy here. So this one, we have 33 different stocks right now all together. And then we have a dividend yield of 4%. And of course, no expense ratio because these are individual stocks. So just kind of something to keep in mind for those that are trying to learn while we go through this process. Similar, again, kind of going back to this, a lot of these funds are also going to be in the VOO fund that we talked about earlier. And then also the VTI, I don't know what I'm doing there, VTI fund as well. So a lot of overlapping, I should say, in this fund, which makes it really difficult for your money to be spread out more evenly because they're already kind of going into stuff like Microsoft and Apple are already in VOO and VTI. Now, I'll keep this in mind too, that I personally have VOOG, which is essentially the like ultra growth S&P 500 fund. And that also has Microsoft and Apple, and I do have these as individual funds as well too. So I'm overlapping in that regard as well too. But as far as how much you're going with multiple ETFs and individual stocks, it becomes really apparent that it's going to be harder and harder for the portfolio to really grow as a fund when everything is getting split up, because all these funds are probably getting very small amounts, more so than they are probably, they might be like $1 here, $1 there kind of thing. So if you would like to have it more concise, it might be more advantageous to consider, restructuring if you are looking at the opportunity to kind of go through the process, because that's what I would do personally, right? Like that's what I talk about is like these funds right here and these funds right here are all so similar to each other. There's a website, and I don't know the name, and if I do, I'll let you know for sure. But there's a website where you can compare the ETFs together, and it'll show you how much is overlapping. And like I said, VTI is going to overlap with pretty much every other fund that you have altogether. Now, the squirrel pie is the one that you said is kind of like your fun one. So kind of go into that with that mindset. So yeah, we have Boeing, Southwest, New Residential. We have ALB, NIO, or NEO, however people want to pronounce that. Genius Brands, all these different companies. So this is, of course, as I can tell right away, is definitely a lot more risk, especially with some of these companies. Like Boeing is still pretty down. NRZ is quite down still from their 52-week high. NIO I know has some pretty popular videos going on right now on YouTube. You can see the 5 years, this whole thing is down by 30%. But if we do, like, let's say last quarter, they're up 11. And for the year, they're still up quite a bit. So that's definitely good. I wonder what took this down. I think it was Boeing that took all of that down, honestly, from the performance side of things. So definitely not a bad thing to have, a little bit of fun with your money there, with investing, and potentially have a little bit more exposure to risk. Obviously, the nice thing is it is only 3% of the portfolio, which is always a solid thing. Keeping any risk a little bit more minimal is what I would personally do, just because I don't want to be so heavily invested. Obviously, other people do, and they do a good job, and I'm happy for them. But for me personally, I don't want to risk too much. So The best thing I can say honestly with this portfolio is just kind of reassessing the fact that like a lot of these things are overlapping. If I were in that situation, I would just kind of consider like condensing it a little bit more for me, just so that way a lot more of my money can go into the funds that are performing really well and are not at that point overlapping with each other. The individual stocks, the only thing I would say with that is because there is the VTI fund and the VOO fund, a lot of them are also overlapping, causing there to be a lot more holdings. So that way, again, money's not flowing into all the funds all the time. So it might be a little hard for some of that to actually have an impact on their growth. Because as an example, if you have like $100 you're depositing and you have 47 holdings, obviously some holdings are going to get more than others, and there's going to be a good chunk of them that might not get any holdings or any deposits into their holdings. So what that means is you're going to lose out the opportunities just because of the fact that that money is not being distributed into those funds. So it might sound like there's a little bit of work to be done, but always the course of action when it comes to building a portfolio that you're happy with, that you're excited about, and obviously have money to be able to continue to grow. Check out my video right over here to keep on watching more. My name is Dennis, and I will see you guys in that next video.